Andrew Stafford, president of Prevail. We're back with Kerry Lawing, our CEO. Fun topic today, our real estate. A lot of the projects we've done, we've just gotten some of the updates out. Let's talk a little bit, Kerry, about a question that I think a lot of people have. What is the difference between dividend, which some people may say is cash on cash, versus internal rate of return, which is a more long-term figure? Talk about the difference between those two and why one matters more than the other.
So, as you know, we just finished our 14th project, really in the last 5 or 6 weeks. And both are important, but let me talk to you about the differences. So some people only want to buy real estate that pays income. Now, so let's say you buy it with an idea that it's replacing part of your retirement income. I get that, and that's important. But usually that project will not provide the same upside over time as one that maybe has lower or less dividends, because most of the deals we're doing, we're trying to do some of both. Now, we did a project in Waldo that's new development that would have no distributions. We've done a couple of extended stay hotels that were new, so it's those stabilize. But generally, those that have higher distributions don't have the opportunity for return later on. It just, you can't do both. You have to pick one lane or the other. Most of the ones we look at, we try to find within a year or so some level of distribution, and then as they go through opportunistic improvements, either in multifamily, unit improvements, light remodel, tenant changes, rent goes up. As that goes up, then the project becomes worth more with some income. So the answer is both are important, but it's not, if you don't have high dividends, it's a bad project. If you have higher dividends, you're just probably not going to get the level of return over time. We have several surgery centers and medical buildings. Those are pretty consistent on dividends, but they're not likely to generate a lot of extra value over the next 6 to 10 years.
So as they're looking at cash on cash or dividend versus IRR, sometimes you can rob Peter to pay Paul and vice versa.
You can be paying attention to the wrong thing.
Right.
You can say, look, I didn't get this dividend, so it's bad. That doesn't mean it's bad, but you sometimes have to say, if I give up a little bit of dividend, I gain return. If I get a lot of dividend, like it's a 6 or 8% dividend, I'm probably not going to have the return over time. The phrase we've heard before, you normally can't have your cake and eat it too, is somewhat applicable here as we vet deals. But reviews are done. Generally, the projects are doing very well. A lot of positivity, rent growth, those kinds of things. One of the most important things on our projects is a lot of them had the insurance go down, which was really difficult to deal with 18 months ago. So that's been a good thing.
If you'd like to learn more, subscribe below or check out PrevailIWS.com.